Good afternoon. There are more people joining. We're just waiting a couple of minutes as people are still getting on the call. Okay. So for those who just are joining, we're just waiting a couple of minutes. Still people joining. And also to let you know, we are recording this meeting. So hopefully we'll be able to distribute it also digitally. Maybe give it a couple of more minutes and then to yeah, and maybe also now could be a good time, Gummi, if you can launch the polls.
Oh, of course they're gone. Oh, I have to redo them.
Okay. So, all right. So I think we have plenty of viewers who have been joining us. Thank you all for attending. I am Ole. I will be your main moderator of this webinar, the first webinar from ICR. And I am the CEO, the COO of the company, and focus mostly on business development. And with us are also Guðmundur and Reid, and I will do a introduction on them a little bit later. The agenda for this webinar will be a short introduction to everyone. Then Guðmundur will speak about the methodology approval process, and that will take approximately 20 minutes. Then Reid will follow up and discuss more about the actual methodology of early decommissioning of marginal oil and gas wells. Then hopefully we will have enough time for Q&A, and we will then reconvene with key takeaways if we have time for that. But let's start with Reid and Guðmundur. Reid is the CEO of Climate Wells, and he is currently located in Austin, Texas. He just told us that it's 32 degrees in Texas, and I will allow him to make more introductions about himself later. But the methodology focuses on early decommissioning of oil wells, and they've been. For how long have you been developing it, Reid?
I started working on this in 2020.
All right. So Guðmundur is CEO of and founder of International Carbon Registry. He is based in Iceland. It's not 32 degrees here. It's more like rain and maybe 10 degrees. Guðmundur was a founder of ICR and has been involved in standards for a number of years and founded the ICR in 2021. And since then, focusing on ISO 14064-2, using that as the core principles for project development. About the ICR, for those who are not familiar with ICR, it was based on the premise that we wanted to tackle barriers of innovation, make it more accessible for carbon projects to evolve and launch into a more standardized framework of sorts. We want to help projects get funded faster by issuing ex-ante credits and have them delivered to tackle the cost-revenue mismatch. We are really keen on increasing transparency of the actual projects. We want to enable more stakeholders in the field to have a voice and have a saying. And we believe that through cooperation, the quality of the projects will shine better through. We sometimes say that we don't want to be judge, jury, and executioner of the projects, but rather we see ourselves as a courtroom where we bring different voices into the courtroom to attest to the quality of the projects. And this means that we are working with insurance companies to innovate on assessing risk profiles of projects and etc. We were also the first to issue the credits publicly on blockchain, which we are doing to increase transparency. So having traceability of the actual carbon credits will be more accessible. I think without having much further introduction, maybe Guðmundur, just if you can start the webinar, and feel free to look us up afterwards and keep in touch if you have any questions.
Yeah, thank you, Ole, for this introduction. Before we start, I've known Reid for now about a year ago since we first met, when we had these challenges in the methodology development. So a methodology is a process that takes time. It's nothing that is done over a cup of coffee. It's a robust and challenging and with a lot of different stakeholders that are involved in the process. So on the this is a short summary of how we do the methodology approval process with ICR. There's no real surprises for you that are experienced in developing methodologies, but we try our best to have it as efficient and reduce the barriers as much as we can. So a little bit of background about, as I will go through a background of methodologies, then go through the presentation of the methodology approval procedures that we have with ICR, and then talk a little bit about the methodologies that have been going through the processes with us since we were established. But essentially, a methodology outlines how to measure and calculate GHG emission reduction, removals, or enhancements from specific activities or projects, and it defines the approach how to determine baselines, monitor the emissions, quantify the emissions, how to report on them, and ensure that all the processes are consistent, so it can be reproducible. They are systematic and verifiable by a third-party VVP. So normally or usually we'll see that methodologies are pretty much the same in structure. They include scope, applicability conditions, some normative references, definitions are important for sake of validation and verification and understanding what they are about. And then it's about how to address the baseline, how to assess establish the project scenarios or boundary, identification of the boundary, how to demonstrate additionality, or is it some tools that should be used or by different means, that qualification, and then monitoring. And it's just why we establish a methodology, and like I was saying, it outlines how to measure and calculate the emission reduction and removal enhancements from specific activities and projects, and why we do that. So it eases the processes of creating a carbon project that is following, is trying to meet the carbon principles that emerged in the CDM and joint implementation under the Kyoto Protocol, and that has been the crucial ingredients in all climate action that entails participation in carbon markets, either the compliance ones or the voluntary ones. So essentially, that the project result in real, measurable, additional, unique, and traceable, independently validated mitigation outcomes that are permanent and where leakage is avoided, and it also are where sustainable development is promoted. And often as sustainable development is used as a buzzword, but it's a crucial aspect of what we are trying to achieve with the voluntary carbon markets and carbon markets in general. But these are then these carbon principles are then translated into either a carbon program, like GSD program, or as a standard. So you would see them translated into how we do it in the ICR program. We incorporate these principles to a requirements that a project needs to meet. And this is also, and like Ole mentioned in the beginning, we heavily align with ISO 14064-2, which probably majority of the audience are familiar with, because we preach that a lot, and that increases the standardization of this space. And ISO 14064-2 is as a standard that was developed last year. The first issue was in 26, similar time as CDM was emerging. But at the end of the day, it's about describing the project, identifying SSR's baseline, the sources, sinks and reservoirs in the baseline scenario, and for the monitoring the project scenario, how to quantify, how you manage your data, how you monitor, and then documentation. And finally, which is of course on the crucial aspect of the project cycle or the methodology development, is the validation and verification of the project and the impact. So about the approval process that we have, it's similar in structure as with programs of same nature as we are. So it's not mandatory, but you can submit a concept note to the ICR where we then give the developer feedback on the ingredients or the concept of the solution. But at the end of the day, we are trying to build out or support innovation in building out quantification methodologies for accelerating climate, like mitigating climate change. So then the developer that completes the methodology, it contracts a VVP for assessing the methodology, and the PDD, which is one of the requirements in our process, is that you need to develop a project, either a real project or a fictional project where you are applying the methodology at the project level. Then it entails a public stakeholder consultation, where we publish the methodology publicly and call for consultation. Then finally, we do a completeness review of the methodology and submit for final approval of the ICR board. About the structure of the methodology documentation, so we have both like the requirements for the components of the methodology, and then we have the procedures on how the life cycle, so to speak, of a methodology. So nothing new here. It's maybe like going through the sections, like 1, 2, 3. It's like a general requirements. Then on the components of the methodology, so it's a reference to other methodologies and sources that guide the implementation of this or the development of the methodology. Summary description of it, definitions, applicability conditions of the methodology, boundary, baseline scenario, how to demonstrate additionality, how to quantify, and then monitor at the project level. Then section 5 is about the implementation of a project, and then finally validation of the methodology. And where important maybe to note that like the criteria for validation are ISO 14064-2 and the ICR methodology requirements. So meaning that like the VVP assesses the methodology for so that with application of the methodology, the project should meet the requirements of ISO 14064-2, which is a project standard. It's not a methodology standard; it's a project standard. So then on the process, like I was just referring to before, it's about creating a concept note, developing a methodology, validation of the methodology, public disclosure. We create the public site for its methodology, then consultation with the public, completeness review, and the board approval. Yes. So and then of course, like all programs, we have templates for everything. So there's the template available on our documentation site for both the concept note and the methodology. So now we have now 6 methodologies. Some are in the process of getting approved. So 3 are in the like mining sector. Then we have plastic and waste recovery, and one that is in nutrition. And we are now receiving 2 more soon. One is restoration of wetlands, and one, that is too early to talk about all this. So that's all for me. So if you have any questions, there is a Q&A section on the right, where you can see the forms on the bottom right. So yeah, I think I'll give it back to Ole now. Thank you.
Thank you so much for this, Gumi. And yeah, just to highlight, please send your questions in the Q&A. If you have any questions, we will then moderate them and ask following from Reid. Also, we have some polls floating around, so please have a look at them. And Reid, are you ready? I see your slides are getting lit up on the screen. So if you're ready, please just go ahead.
All right. Hopefully everybody can hear me and see that okay.
Perfect.
Awesome. Thank you, Guðmundur. Thank you to everyone for tuning in. I am Reid Calhoun. I helped write the methodology we're going to be talking about, and my company, Climate Wells, is one of the developers underneath methodology. One thing before we get in further, just a brief synopsis of like what a carbon credit is and why it might be used. There are something like 1,200 companies in the Fortune 2000 who have made climate commitments to handle their emissions. One piece of that, the most important, is that they reduce emissions within their own supply chain. The second piece is that for those emissions they cannot reduce, they look at the carbon market as a way to buy credits to offset those emissions. So there's principally two types of carbon credits. The first is you're sort of paying someone to store emissions that they would have otherwise emitted. And the second is you're paying someone to remove emissions from the atmosphere that have already been emitted. Just to give you a frame of reference for why groups may be interested in purchasing carbon credits, as there is an increasing need to tackle the climate crisis. One thing that differentiates our projects from others, the majority of emissions attributed to these companies and individuals are related to fossil fuel use, whether that's energy supply from a utility or driving their car. We directly reduce fossil fuel emissions, which we think is just like a paramount way to tackle this. But let's jump right in here. So oil and gas makes up about 50% of all global emissions. Historically, there has been no mechanism for drastically cutting those emissions without proportionally cutting our energy supply. Though through the methodology we've created, we identify a subset of oil and gas wells that make up only 5% of our production, but as much as 70% of those emissions. These are the wells that we think we can shut down far earlier. The colloquial term for these wells is stripper wells or marginal wells. They're called that because they use all sorts of techniques to strip the last drops of oil out of the ground. These photos may look familiar if you've driven throughout many areas of the United States. In California, these wells are in the middle of neighborhoods. These old wells are on Native American reservations and in frontline communities that feel the worst effects of climate change first. So this is sort of what the story of each one looks like. These wells are drilled in the early 1900s. By 1975, they become marginal, producing very low amounts of oil. And each year since 1975 and until they're ultimately decommissioned or orphaned, they'll produce 3.5 tons of methane per year per well, and often over 1,000 tons of CO2 emissions. And they exist because they still produce some amount of oil, and they break even, or maybe they make a small profit. However, when you measure the emissions of these wells and put a price on those emissions through the carbon market, we suddenly have a compelling opportunity to decommission these wells potentially decades earlier. Here's what the emissions look like. It starts upstream. Many wells vent excess methane, or they flare it and light it on fire and turn it into CO2. Or these are just old wells with a bunch of leaks. But also there's emissions in transmission of the oil and gas to the refinery. At the refinery, you have steam methane reforming, catalyst regeneration, and of course the combustion of the final product downstream. It should not be surprising that an oil and gas well has a lot of emissions attributed to it. They make hydrocarbon, so byproduct of that is carbon emissions. So this is what the life cycle emissions of oil and gas look like, and the model that gives us this information is called the Oil Climate Index. It's run by the Rocky Mountain Institute, and it's constantly updated when we look at evaluating the amount of carbon from any given well in any field. The Oil Climate Index tells us the amount of carbon emissions in the life cycle of every barrel produced. Our projects are ideally fairly simple. If a well or a field of wells is applicable, which means it's currently producing and going to continue to produce, it's economic, and it's, plugging it isn't going to cause adverse effects. A couple other parameters. We need to understand the amount of oil and gas we'll be keeping in the ground, and we need to figure out the amount of emissions attributed to that oil and gas. That's given to us by the Oil Climate Index I spoke about. And then we try and sell the credits attributed to shutting that well down early at as high a price as we can. As soon as the well is plugged and the pertinent regulatory body has confirmed that the project is complete, we then pay the company to plug the well. So we don't have to keep a nature-based solution alive. We store our emissions underground, and each project is hopefully fairly simple from start to finish. I wanted to include this slide for two reasons. One, on the left, to give you an understanding of methane emissions. So methane is as much as 80 plus times more potent than CO2. Whereas CO2 can be augmented by nature, methane is a pollutant that requires industrial action. And according to the UN's International Panel on Climate Change, it is the most urgent focus for the environment this decade. On the right, we compare our project to three of the more popular projects in the voluntary carbon market today. One big differentiator is the location of our projects in all 50 states. If you're going to take climate action as a corporation, we believe taking action that delivers tonnage quickly within this decade and delivers for the customers and for your employees in the areas in which you work is important. We also store emissions permanently out of the way of forest fires, soil erosion, land use change, and these projects are very quick. It takes about 2 weeks on average to shut down and clean up one of these well sites. Here's some specifics about the credits. We have had the methodology reviewed and approved by a dozen certifiers, and we're currently undergoing the validation step with ICR as we speak. We're in line with all the regulations and guidance from all the pertinent carbon leadership groups. Through ICR, we're registering with, as legitimate a third-party carbon registry as you can get. And we're currently going through another methodology review, this time with the Bureau of Land Management and USGS. So our pilot project is being completed as we speak. It's pending final verification, which should be done by September. We were lucky to partner with JP Chase to help an operator shut down an inner city legacy oil field in Los Angeles. These wells actually sit behind a youth baseball field in the Wilmington neighborhood. In this case, and in the case of all our projects, mobilizing carbon finance helps create a very economic opportunity to cut emissions and creates jobs. And instead of excluding small operators from the conversation, we've created an opportunity to cut billions of tons relatively overnight by working with energy companies. We have a number of projects that we are working on next. This one is outside of Fort Worth, Texas. We're excited about the chance to essentially reclaim a large agricultural area for a set of landowners. Like our Wilmington project, this helps bring jobs, oil and gas jobs, to an area that has declined in production for the last 20 years. We think there's a really great opportunity to just take care of wells that are nearly 100 years old. And one more here. This is a residential oil field in East LA in the Yorba Linda neighborhood. These wells were drilled in this neighborhood, or before this neighborhood existed. The operator is the 12th owner since records began in 1911. The health data on people who live within 1,000 meters of an oil and gas well is stark. Better yet, those that share a fence. So we would definitely be excited to take this one on. And I'm going to stop there. I'm happy to take questions. I'll give you the caveat that this is an early. We're going through validation now. It's an early concept, and so we're excited to kind of hear people's thoughts, concerns, and criticism. So yeah, thank you very much.
Thank you very much for this, Reid. So if there are any questions, please post them in the ask question box. You should be able to see them. All right, we have one, the first question here arriving. Could you reference the health data you mentioned, Reid?
Yeah, there have been a lot of there's been a lot of research done in specific to LA because it's such a large urban oil and gas field. You can find some articles on the GRIST, Communities for a Better Environment, and Stand LA have all done research on the health effects attributed to communities that live offsite these wells. And if you reach out to me directly, and all my contact info is there, I can send you the exact links.
Thank you for that. And
So we have maybe could jump in on one thing. Like we have like completed like the public consultation on this methodology, but like if you go to our website or into our documentation, you would see that the public comment option is still available. You can still submit public comments if you have any questions or concerns about the methodology.
Great, thank you for that, Guðmundur. The second question: how do these projects compare with other projects in the voluntary carbon market? Reid.
Yeah, I will go back to that slide because maybe it would be helpful. Yeah. So these three other projects on the right-hand side, landfill gas. So a landfill is leaking methane and we convert it into power. Cook stoves, we go from dirty fuel sources for cook stoves to using renewable energy or other cleaner fuels. And then forestry and land use. And that's a mix of planting new trees or keeping trees that are there alive. So, as I think about carbon projects, you can store carbon underground or in the geosphere in the earth, or you can store it in nature-based solutions in the biosphere. So the former of those is going to be much more permanent. We tend to think that storing oil and gas and hydrocarbons in their native reservoir, they can stay there for 10,000 years. Whereas storing things in something that needs to live, as the world gets hotter, that's going to be a little bit more difficult to guarantee permanence. I also think that stopping emissions at the source has really natural advantages. When we chose to work on this, and we're a venture capital backed company, and as such, it was like our only option is to do something that we think could be very large, make a huge effect. We emit 55 billion tons of carbon per year globally. So there are a lot of really interesting ways to remove 50,000 tons over 10 years, like very, very interesting ways. But for us, it was how do we do 1 billion tons by 2030, or how do we do 10 billion tons by 2050? And there's no other for us focus. So, for the last 100 years, there has been no price on carbon emissions. So it shouldn't surprise you that when you introduce a value on a ton of carbon, the highest emitting industries can cut 1 billion tons relatively overnight at a very low price. And so that's sort of been the thesis for our business is how do we find the low-hanging fruit? Mm-hmm. There's a lot of opportunities for huge innovation, but maybe there are opportunities to cut, large amounts of tons just by bringing the carbon market to bear in any form. So hope that answers the question.
Maybe I could jump in on that as well. Like on the like Gutierrez said, we need everything, everywhere, all at once. So this is just one of the solutions that we need to have in mitigating climate change. And if you just look at the CDM methodology booklet, you find 200 different methodologies. So this is just to allow for more innovation in the space. we welcome a new innovative solution. And you would see that there's not that many methodologies addressing exactly what you are addressing out there.
Yes, thank you. The next question from Sajini Patel. I hope I pronounced it correctly. Firstly, great step towards developing this work. Secondly, I wanted to learn how this methodology being developed for oil well plugging stands out from the one already presented in January 2024. Are there any caveats especially being addressed through this methodology?
Yeah. So the biggest difference is this is for active wells. The previous methodology came out from, I think, American Carbon Registry is for orphan wells. On average, an active marginal well produces about 100 times more methane emissions than your average orphan well. In fact, I've been out to a bunch of orphan well sites. An orphan well is one in which the operator went bankrupt or otherwise disappeared before shutting the well down. Through our projects, by coming along when the well is, somewhat break even or slightly economic, we not only stop the emissions of that marginal well, but we prevent it from becoming an orphan well. So sort of two birds with one stone. We think the orphan, and there are great teams working on it, but we think it is a symptom of a greater problem, that there is no economic capacity to shut down oil and gas wells, especially in the US and in Canada. The solution in regulation that was supposed to fix this is called bonding. And what that means is when you drill a well, you put up a certain amount of cash to cover the reclamation and shutdown of that well toward the end of its life. Unfortunately, wells drilled in like 1905 had some incredibly small amount of bond put forward that was not inflation adjusted, and plugging costs have gone up. So today a well may only have $1,000 from a historic bond from 1920, and the well's going to cost $50,000 to plug. So that, in combination with the fact that the companies that can keep these wells economic for the longest period of time are often the companies with the lowest amount of overhead, and potentially those that are the least financially solvent, creates this issue in which there's just not financing out there to shut a well down, which is why we have orphan wells in the first place. So we tend to think that we are focusing on a larger stack of emissions, and projects are far easier when a solvent operator is still in play. They know what's out on the well. They're able to go out and take care of it with their own services. So we think this moves a lot quicker and it gets a lot bigger.
Okay, thank you. I'll just keep the questions coming. And please, if you have more questions, then just add them into the box. This one is also for Reid. Based on your experience with run title and tracking asset transfers, what lessons have you applied from the data business to managing and promoting carbon reduction projects?
Yeah. At Run Title, we track the transfer of, and that was my last company before starting this, we track the transfer of oil and gas wells between different parties. Once a well reaches what I'll call terminal decline, meaning it's produced 95% of its oil and gas and it's producing 4 barrels a day and will for the next 25 years, it starts to trade hands rapidly, because nobody wants to be holding the bag on the liability toward the end of its life. So they'll keep it economic for another 5 years and then try and get it off their books to someone else. And so that leads to this orphaning problem, where eventually the owner at the end, when the well breaks or otherwise can no longer make money, just doesn't have the cash on hand to go and shut these wells down. So I think through Run Title, I just watched the data around asset transfers and tried to figure out a way in which we could create the first return on investment of stepping up and doing the right environmental action.
All right, thank you. So let's try this one. I'm not sure if I totally understand the question correctly, but let me try to do it justice. I read that a developer must be working with or know the RMI team. How can a well services company become a developer using this methodology if they have operators willing to pursue this option?
Yeah. The Rocky Mountain Institute and their tool, the Oil Climate Index, are very easy to approach. The reason that's in the methodology is because the core piece of determining determining the emissions of any given well is using the oil climate index to do so. So what we don't want is to bring a lot of projects to market, and then the verification step, it's clear that like the oil climate index either wasn't used or wasn't used properly. So that's why we've laid out that you need to show expertise in use of the model, and then it's up to you to work with the verifier to demonstrate that expertise, just like any other project type.
All right, great. Thank you. The next one is for Mr. Guðmundur. What differentiates ICR from other players in the field?
So there are multiple aspects, and like on the first, like you said in the beginning, like why we were established. So we wanted to tackle the barriers in the space. So first on the lack of standardization, because we have all the VERA, you have the gold standard, you have the ICR, you have the CAR, all these different standards. So we wanted to have like a standardized framework relying on the foundation of ISO standards from the core criteria of the ICR program. So all projects are subject to validation to the ISO 14064 series of standards, and the accreditation requirements are also that they need to have an ISO 14065 accreditation. So tackling like at least the standardization issue. Then on the methodologies, I hope you agree, Reid, that the methodology process is pleasant with us. So we want to like at least try to have the methodology development phase more efficient. So we want to recognize the expertise from the VVPs in conducting the assessment of the methodologies. We only require one validation of the methodology, and then completeness we want on our hand. Then on the ex ante and ex post issuances that like allow certain project types or project that meet certain additionality threshold to issue credits ex ante that like is essentially a foreign contract, and that aligns like with how the climate works. Like the climate acts in a continuum, so like corporates should like act in such a way instead of calling for offsetting, like annual offsetting, rather look at the pathway that we are towards reaching net zero, hopefully before the mid-century. Then, of course, the registry platform itself, how we want to increase transparency. And transparency can be multifaceted, like dumping documentation on a registry in a PDF documents. Yes, it's transparent. You can educate yourself on what climate action is and what are the requirements. But we, of course, require all the projects to go through the regular project cycle. But like what we allow the project to do is to, through our platform, is to promote their efforts to tackling the problems that the ones that are relying on carbon credits are not doing currently. So through social posts, through other medium, pictures, videos, etc. So yeah, thanks. So.
All right. I have another question coming in from Mark Bursman. I saw the mention of insurance in one of the first slides. How are you incorporating insurance into these credits?
Maybe you take this one, Ole.
Sure. So the first slide that you're referencing basically describes the levels of players that we see as trust brokers in the market, and the ICR really wants to incorporate insurance companies to take a more active part in the carbon credits market, due to the fact that they have different interest and different incentives from others, so they view risk from a different factor. And so currently there are not any insurance as I know of, or an insurance program directly tied to these credits, but this might be introduced in the future. But for example, we at ICR are working with Kita on buffer pool management, and we see that as a first step to introduce new aspects on how we evaluate risk and how we approach risk and how we approach accountability. And essentially this goes in line with the view that I mentioned before, that we don't want to have just one loud voice in the room. We rather want to have multiple expert voices that can have an opinion, and it's really important that we allow those voices to be heard and also participate in the market to increase the quality and also the value of the credits. I hope that
Yeah, add one more thing, and like this is the step is the personal insurance with Kita, and like then we will work on other insurance product with Kita or on other insurance companies if they choose to the market.
Sure. Okay. Another one for Reid. Could you explain a little bit more about how the credits are generated, avoided methane and oil production, and can you explain how the volume of oil in place is estimated and the risk associated with that estimation? Thank you.
Yeah, of course. I'll answer a couple questions at the same time here. I think I was also asked, are we selling these through the VCM or the compliance market or B2B? We try to sell these bilaterally directly to companies in a one-to-one agreement. I found that buyers of carbon credits are particularly interested in having a little bit more say in the project. I would sure love to be in the compliance market as well, maybe over time, but we've started off in the voluntary carbon market. As far as issuance and how we measure emissions. So an oil and gas well emits in what we think of as upstream, midstream, and downstream. Upstream being direct emissions like venting, flaring, and fugitive emissions. And then like midstream is, on the way to refinery. At the refinery, the product inherits a significant amount of emissions. And then downstream, most of that is combustion. So when we think about what emissions we stop when we shut a well down, it is how much was the well going to attribute to global emissions over the time frame that it would have continued to produce. For us, we're pretty conservative. We limit the total time frame that a well can be credited at 10 years, even though many of these wells will produce for another 50 years. We also say only the economic oil and gas that would have been produced, even though wells produce far past their economic break even. So the amount of emissions that we attribute to every barrel is a combination of methane, for sure, and CO2 emissions in the midstream and the downstream process. As far as determining how much oil and gas is in place, we use best-in-class carbon credit standards in that we hire a third party that is a professional petroleum engineering firm to give a proper, diligent opinion on the amount of oil and gas. Whereas when you estimate how long a tree might survive for, or how much carbon that tree may hold, there's a lot of on-site sampling, and frankly, it's a little bit more art than science. The amount of money that has been put into determining the amount of oil in a certain reservoir or attributed to a certain well, it's orders of magnitude larger than those that have been put forward towards nature-based solutions. So we feel very confident in the evaluations of how much oil and gas we keep in the ground, especially because we've limited these projects to marginal late life oil and gas production. We're not having to guess at how much a well is going to produce as soon as it's been drilled. Instead, we have production every single day over the last 20 to 50 years and can somewhat use that historical production to back into how much is going to be produced. So we've put overlapping conservative measures into the methodology to make sure that we are hyper conservative in how much oil and gas we're estimating would be kept in the ground.
All right, thank you. One more for Reid. How do the sale of credits compare to the plugging costs and lost income from oil sales from marginal wells?
Yeah, so today they're less. If you made more money from carbon credits than producing oil and gas, then like all oil companies would turn into plugging companies. Today, we try to work on projects where we can cover all or part of the reclamation cost. We're specifically working on projects where the total value of oil in the ground is just not overwhelming. If we look at a field or at a well that has $1 billion of oil left to create, that operator is probably not going to want to shut that field or that well down until carbon prices get a lot higher. But there is no lack of wells. In North America, you've got 1 million wells that produce 5% of our oil and gas and 70% of our emissions. So of those 1 million wells, even at $5 carbon, there are a lot of wells that are a good fit here. So short answer, we try to cover all or part of the reclamation costs, and we find that that is a pretty meaningful incentive for our early projects. I think over time, as our projects are de-risked, as people see the value that we can drive quickly in delivering this decade, we'll be able to charge more on a per ton basis and maybe get to a point where we can cover the present value of the long-term royalty stream. That would be a really great situation for us, and that's where we're headed.
Nice, thank you. And maybe a small follow-up on this one. Like, is there additional benefit on closing down these marginal oil wells versus the larger developed oil fields, like proportionally, like how much of emissions, etc., they contribute?
Yeah, so most marginal wells are older wells, and the emissions intensity of a well doubles every 25 years. When we look at, again, this concept of like low-hanging fruit, when we look for the easy, quick things we can cut out of oil and gas emissions, the old marginal wells are a simple one. You talk to any major oil and gas developer, they aren't proud of the wells that produce a half barrel a day. It's not the image of oil and gas that they view the future of the commodity. That said, I think there are some fields in Southern California and some fields in Canada that produce a lot of oil and gas that produce as much as a ton or more per barrel. And so I tend to think that not all oil and gas is bad and not all oil and gas is good. And if you can accept that as a reasonable reality, then you can kind of identify which oil and gas we probably don't need. And carbon credits create a great opportunity to decommission some of that a bit earlier. I hope that answers your question.
Yeah, thank you for that. So we're almost closing in on end, but there's still questions coming in. For Reid, how do you deal with Appalachian states then where production is only reported annually? And how do you manage, say, gas wells in Texas where production is reported for the lease? Do you allocate or do you do the entire lease?
Yeah, I love the deep oil and gas questions here. So we haven't done a project in Appalachia yet. We need a reserve report to tell us how much oil and gas we're going to be keeping in the ground. So it's not necessarily like public reporting data. We do need to know that the well is continuously producing. So we're going to access public data and private data and try and verify that all of that information is correct. As far as lease allocation, yeah, I mean, in Texas, where we're dealing with a gas field where we have to think about production at the lease level, we want to shut down the whole lease so that we don't have to do per well allocation. We really think about, and there's a question in here as well about reservoir communication. Our methodology does not allow us to plug one well that has another well that's going to produce the hydrocarbons that would have been stored underground from the first well. We have really, really clear both quantitative and qualitative measures for ensuring permanence. So you can read that in the methodology, and there's a full flow chart to walk you through how we keep oil and gas in the ground.
Sounds good. So I think we're almost out of time. And Dan says thank you. Thank you, Dan, for this question, and everyone here for these questions. But Guðmundur and Reid, do you see any key takeaways from this talk that you want to share with the ones who are in this webinar?
Guðmundur, you want to start?
Yeah, maybe just there's a lot of interest I see in this methodology that you've been working on, Reid. I would want to see next time more questions towards the awesomely bureaucratic methodology approval process. Maybe that we'll keep that for later. But yeah, there are a lot of interest I see in this methodology.
Well, thank you, Oli and Guðmundur for putting this together. The methodology review process and approval process and the rigor and diligence that ICR puts in is not to be taken lightly. We have gone through a number of reviews, and they make it as easy as they can, but they are remarkably specific and clear in the way that they walk through a methodology to make sure that it meets not only their own standards, but also the International Standards Organization. I think one thing that's gone particularly well with ICR here is they have, to their credit, focused on projects that can deliver tonnage soon. And I think that that's a really important thing that's not talked about enough. If we think about our emissions as liabilities, and we think about carbon credits as assets, our emissions every year accrue warming or interest. And every single year, something you emitted last year is causing damage. Yet we see investors, especially in San Francisco, going and investing in things that won't be delivered until 2050. And so I think it's paramount that we focus on which projects can deliver tonnage by 2030, which can focus on refrigerants and methane, and which projects are permanent. So I think, I'm biased, but that's why we've aligned our project to that type. Thank you everyone for asking great questions. Please reach out. I'm happy to engage and have further combos with anybody who's interested.
Thank you all. Thank you, Reid.
Thank you.
Bye-bye.